Hi, you're investing in stocks and you really want to know where the stock is going over the next 3 months. Well, listen in. The post-earning announcement drift, or PEAD, on the EPSMomentum.com website is actually telling you exactly that. Okay, so let's have a look at this post-earning announcement drift, PEAD. You can click on that widget here, and it will open this big widget with several parts here. So what is PEAD, or post-earning announcement drift? So it's basically one of the most famous anomalies that you can find in financial markets. It's been researched for over 50 years. There's numerous research and white papers written on it. And a famous farmer said it was one of the most powerful anomaly you can find in stock market to look at the stock price movement going forward. So at EPSmomentum.com we created the first ever PEAD calculation analytics that gives you exactly that, the forecast, the statistical forecast of where the stock price is actually going. So how does that work? Well, everything is based on the two numbers that you see here: the overnight change during the day of the earnings and the current day change of that day, so from open to close. So the overnight change from the close of the day before to the morning, the open, and when the stock opens, the actual first day of trading after the earnings numbers have been published, right? We call it earning day. So what does that mean here? It means that it went up 4.43%, so it gapped up pretty much. Well, not gapped up, but it went up from the close to the open 4.43, and after that it went up another 6.20% on the day. Okay, so let's have a look at this on the chart. So here we can see that it really jumped, and then on the actual day went up big 6%. Okay, so what we did is we took all the quarters of the stock going back in history and look at all of their changes the overnight and during the day of the first day here. So if we look at this quarter, you can see it jumps up, but if we go back also here, you can see how there's some sort of a pattern here, because it always jumps and then the day of it, there's a wild move here. Same thing here, it jumps and there's a wild move. So there is a pattern in all this, and this is what the PEAD is identifying here. So what are those patterns? So basically you have four cases. The overnight is positive, and the move during the day is positive, or one is positive, the other one is negative, or negative positive, or two of them are negative, right? And this is how it happens. You have full possibility, the drift A, so they're both positive, the overnight and the change are positive. Then the stock will just go up and then drift up all the way to the end of the quarter. Okay, so that means that investors have underreacted to the move. It's a positive move, but they should have bought the stock more. Since they didn't buy it more, it will drift up all the way. So why is this important? Because the overnight price change right after earnings is let's say the first reaction of the stock. You know, the numbers are out, the company has done his calls, conference calls, so people are still crushing the numbers and reading through the transcript of the call or listening in, and so the information is not really processed by investors. And the volume is quite weak, because the volume in the post-session and pre-session is very weak. So if anything, it's either retail investors or small volume going in. Yes, there's some blocks being traded, but most of the time it's fairly low volume. Whereas during the open and close, if a big fund manager, big massive fund manager, knows that this stock is one of the stock that he should have, no question, if he wants to capture growth, then he will jump in during the day and buy as much stock as possible without moving the stock price. The problem is that he does move the stock price a lot, right? So usually they buy it all over the day at VWAP or also. So because of their sheer size, they're pushing the price up during the day. So that second part, the open close change, is positive, meaning pushed up, meaning the institutional investors have bought the stock aggressively for the quarter. But the thing is, they didn't buy enough, right? So they choose to buy the first day, and maybe they buy even more because the analyst research is published on day 1, 2, 3, 4, 5, 6. Over the next 6, 7 days, even 20 days, you see all analyst research being published, and then the fund manager is saying, oh, I didn't buy enough of these, so he keeps buying all the way to the end of the quarter. Drift B is the second case where you have you have a positive push overnight, but then a negative one, right? So a negative open to close. So yes, there's a positive push, numbers are good, but the actual institutional investors are not so excited about the stock. There's some caveat there. So the stock tends to go up in this fashion, and then drifts down till the end of the quarter. So that's interesting to note. On the third case, you have negative and positive. So this time the stock drops down, right? And then investors go, oh, maybe we over and reacted on negative. It's still a good stock. Maybe we should jump in. Or it dropped down too much. Let's buy some more. And it drifts back up, right? And the fourth one is obviously negative and negative, where it's negative and the reaction. The stock drops and goes down further, right? So these are the four cases. And these are the four cases that you see here. Price going up, drifting up, price going up, drifting down, price going down, drifting back up a little bit, price going down and down, although this downtrend is not super clear here. So this is how you start using the PEAD. The first thing you see is drift A, B, C, and D. So positive underreaction. If I click on B, I get positive overreaction. If I click on C, negative overreaction, and D, negative underreaction. So I click on A. So the PEAD widget wakes up on A, drift A, meaning the stock is now in drift A. It went up and up, so it's really in positive mode, right? And what it says straight away is that statistically, you can see that number here over the 20 quarters. So we take 20 quarters back. So that's several years back, which is useful. So statistically, there's 5 quarters where it actually happened. And during those 5 quarters, the min curve is here, the max curve is here, and the average curve is here, is the average move that the stock has done. So if we apply that move to the current stock price at the beginning of the quarter of 47.88, it's saying that it will go up 14.29%, i.e. going to 54.72 in price. Okay, so it's telling you that it's going to move 14% up, which is kind of useful because now I know, all right, so if the stock is in this configuration, statistically, it will go that high. Or potentially it could go that high. It could go down, it could go low, it could go all the way to 61 or 47. Obviously, it can go above or it can go below. It is just an indication and a statistical estimation of where it could go based on the 5 quarters over the last 20. Here, drift B, there's only 2 quarters out of 20, so it's a little bit of an indication, but it's very difficult to draw really an average with just 2 quarters. So maybe there's a little bit less reliability here. Here on drift C is 6 out of 20, so here I can see a drop down and then kind of plateauing, going slightly down, 1.71% down. Enter drift D, again 3 occurrences, drift down, and then 6% drift in total. So let's look at the second part of the widget, which basically tells you the change from the day before. So basically the day when they produced the earning, but before the earning trading day. Earning day is actually the day where it starts trading after the earning. So as you can see, it went up 443% between the day before and the open. And during the day it went 6.20, so we explained those two numbers here, they're here. And on average, they went up 381% or 425. So here I'm already above the average. The important thing is here I have several points. I have the ED plus 7 days and ED plus 20 days. So if I look on the chart below, I can see the overnight, the 7 days, and the 20 days. Sorry, 7 days, and this is the 20 days here. Right? So I can see how the stock is moving compared to the average. I can see the changes and the percent change and see how it progresses. Obviously, for this stock, we're very well advanced in the quarter, so the quarter is almost finished. But as you can see, it has pretty much stayed inside that funnel of estimation. So it was a pretty good estimate of where the quarter would go for that stock, right? So that's important. These two numbers, are spread to drift and relative spread to drift, are important. So first we have the toggle button here. The toggle is actually telling you, yes, this is well found, 14.29% up. But what if the stock market, the overall stock market, went up 10% over that quarter, over those 5 quarters, or 3% or 2%? What if it was all driven by the stock market? So now you have the ability to do a relative variation, right? So now it's not 14%, it's 12.99% because the stock market went up as well. So now it is in relative term, and we've removed the effect of the overall market going up or down. So now these are true relative terms. So here you can see the spread to drift. So spread to drift is basically the distance between the last point in red and the average. So here we are 10% away, right? And for the relative spread to drift, we're 9.25. Okay, so this 10.5, I removed the relative to SPY. This is the distance from here to here. And if I click on relative to SPY, this is the 9.25 is the distance between here to here. Okay, so very quickly you can use these numbers to see how far the stock price is from the average. You can use the drift to identify good stock. So this is what we're doing here on the screener. You have an entire section which is PEAD. You have the drift name. You can sort by drift name. Let's say I want all the positive under reaction, the drift A. Right, I want to have the percentage distance from the drift. So here I'm 39% from the end of the drift, or adjusted with the benchmark, I'm 39, 41. This is the price of the day of earning of the overnight to the open, and this is the open to close. Right, and this is the next reporting date. So there is filters here, so you can quickly identify where you are here. So if I click on Adobe, right, I can see that I'm in drift A. Most of the drift A, 5 out of 20 are negative ones, which is interesting. But then I have good drift on B. So that's an interesting reaction over 7 quarters. So this is fairly telling. And here drift A, it's actually, it followed exactly the funnel, but it looks like it broke out of it. So that's interesting too. Does it match a drift B? maybe it matched a little bit of a drift B here. Was it significant? Yeah, it was significant. So you see, sometimes it doesn't go as expected, but sometimes it does, right? So if you take another stock, TTC Toro Company, for example, that's in drift D, 4 out of 20 going down, 3% down. You can see this is like kind of spot on as well. Went down and then back up and stayed in the funnel here. So again, very unique and useful. This is something that you won't find anywhere else. This is a truly unique piece of analytics. It gives you a forecast of where, a statistical forecast of where the stock price is going based on historical quarter and institutional behavior. Again, this is really truly unique. So play around with this, and if you haven't done so already, sign up for an account at EPSMomentum.com. Thank you.